Welcome back to Daily Digests for July 29th, 2026. Today brought a dual surge of market volatility across central bank policy and mega-cap tech earnings. The Federal Reserve maintained interest rates in a 9-3 vote, but quietly announced a shift toward buying short-term Treasury bills starting July 30th to maintain bank reserves. Hours later, Meta's Q2 earnings revealed a steep free cash flow decline and $238 billion in off-balance sheet AI commitments, contrasting sharply with Microsoft's 43% Azure cloud growth.
Our top story centers on the Federal Reserve's July 29th policy decision. The FOMC voted 9-3 to keep the benchmark rate at 3.5 to 3.75%. Notably, three regional Fed presidents, Lori Logan, Beth Hammack, and Neil Kashkari, dissented in favor of an immediate quarter-point rate hike. The three dissents highlight growing internal concern over persistent core inflation and energy price volatility.
Alongside the rate decision, an accompanying implementation note revealed a key balance sheet update. Beginning July 30th, the Federal Reserve will begin purchasing Treasury bills and treasuries with maturities of 3 years or less to maintain ample banking reserves. While the Fed frames this as operational reserve management rather than formal quantitative easing, it effectively adds liquidity to short-duration Treasury markets. Market reactions were volatile following the press conference. Indexes initially rallied on the rate pause before turning sharply lower as bond market spreads reacted to the three hawkish dissents and unwinding basis trades. Technical market analysts noted that institution-driven arbitrage unwinds in Treasury futures created sharp afternoon intraday swings across major indexes. After the closing bell, Meta Platforms released its second quarter financial results. While revenue grew 28% year-over-year to $60.8 billion, net income fell 14%. Earnings per share came in at $6.18, missing Wall Street expectations of $7.14, due to a $2.4 billion legal charge and increased infrastructure depreciation. Beyond the top-line numbers, investors focused heavily on Meta's updated 10Q filing disclosures. Meta revealed $238 billion in total non-cancelable contractual commitments for data centers, servers, and network capacity. Of that total, $42.3 billion is payable in 2026, followed by $47.7 billion in 2027, highlighting the massive multi-year cash obligations tied to its AI infrastructure build-out. Meta's aggressive spending squeezed its cash generation during the quarter. Capital expenditures reached $31 billion in Q2, while full-year CapEx guidance was narrowed to between $130 billion and $145 billion. As a result, quarterly free cash flow dropped 91% year-over-year to $784 million, down from over $8 billion in the same period last year. In contrast to Meta's cash flow compression, Microsoft delivered strong cloud monetization results. Microsoft reported second quarter revenue of $90 billion, up 18%. Intelligent Cloud and Azure revenue grew 43% year-over-year, topping consensus estimates of 40%. Microsoft also reported a commercial backlog of $678 billion, demonstrating enterprise demand for its AI Copilot services. Hardware supply chain stocks experienced parallel turbulence. SK Hynix shares dropped 19% in Wednesday trading after management announced a 50% increase in capital expenditure for high-bandwidth memory capacity. Despite record Q2 gross margins above 80%, traders sold down the stock over concerns that rapid industry expansion could lead to medium-term memory oversupply. The surge in semiconductor complexity is creating specialized opportunities elsewhere in tech hardware. Semiconductor testing supplier Teradyne reported that AI-related testing demand now accounts for 60% of its revenue. Driven by rigorous testing requirements for HBM4 and advanced DRAM packages, chipmakers are expanding capital allocations toward automated test equipment. In fixed income, inflation expectations are displaying a notable curve inversion. The 5-year TIPS break-even rate has fallen below the 10-year break-even rate. This inversion indicates that bond traders expect elevated inflation from recent energy shocks to prove transitory, pricing in slower medium-term economic growth rather than runaway price increases. On the regulatory front, SEC officials discussed a proposal to allow public companies to transition from quarterly earnings reporting to a semiannual model. Proponents argue that semiannual filings would reduce short-term corporate engineering and lower legal disclosure burdens, while critics caution that retail investors would lose timely visibility into corporate balance sheets. To recap July 29th, the Federal Reserve's 9.3 hawkish rate hold is paired with stealth T-bill balance sheet expansion starting July 30th. In tech earnings, Meta's $238 billion off-balance sheet commitments and FCF compression contrast with Microsoft's $43